Welcome to Fairport Flash, the monthly economic update powered by the Fairport investment team. Our team gathers the most recent news, data, and research and distills it into the information most important to you. Let's get started. Welcome to Fairport Flash. My name is Kristen Lucas, Chief Marketing Officer at Fairport Wealth. Joining me is Chief Investment Officer John Silvis. As you know, John oversees the research of the investment team, determines the asset allocation of Fairport's model portfolios, and directs investment decisions and implementation on a day-to-day basis. Let's jump right in. John, it looks like the capital markets, meaning both stocks and bonds, have had a good year so far. What has led the way?
It's actually been a great start to the year. The S&P 500 is up about 20%, while the ACWI, which is a global index, is up about 16% through the first 7 months of the year. As far as what's led, large cap domestic equities and real estate investment trusts, or REITs, have led the way. REITs have been the best performing asset class so far through the first 7 months, and they're up about 21%. Both stocks and bonds have been up over 10% so far for the first 6 months of the year, first half of 2019. The S&P 500 was up 18%, while the long bonds, or basically the 30-year Treasury, was up about 12.2%. That's happened 10 times since 1945, and every time, 100% of the time, stocks were up 1 year later, with the average about 16%. So if history is a guide, we should see further appreciation in the next few quarters. However, corrections will happen and are to be expected. While markets have been positive, we have experienced a pullback here recently in the month of August, and we're down about 7% from the high. According to history, and we use Ned Davis research to help us with this, you average about 10% correction every year and about 2 to 3 5% corrections. So they are to be expected.
So what has been the cause of the recent market volatility? Is this normal?
There's a lot of things that have caused the increase in volatility, and probably can't go through all of them, but one is the Federal Reserve recently cut rates back on July 31st. There's been a threat of increased tariffs, which is the president mentioned putting another 10% on additional $300 billion, I think, starting September 1st. And then there's been concern that we're at the cusp of some type of currency war with China. And I think if you look at also in China, there's been some issues with what's going on in Hong Kong and some pro-democracy movements, and that's always a concern that could escalate further. But I think the big picture is we're just seeing slowing global growth out there, not only here in the U.S., but also in other parts of the world. And I think that's causing interest rates to continue to fall. So in the United States, our interest rates have fallen, but I think if you look outside the U.S. and Europe, in the UK, Japan, we're also seeing rates fall as well. So I think in the big picture, we're seeing a global easing cycle starting. Since August 1st, there's been 20 countries that have cut interest rates. I won't go through all of them, but not just here in the US, but we've seen it cut in Australia, New Zealand, Thailand, I can go on and on. I think the other thing is, as the Fed announced they were going to cut rates, and they did cut rates back in their meeting in July 31st, they only cut 25 basis points. And I think there's a fear that the Fed's not acting quick enough relative to other central banks around the world. In fact, there's $15 trillion right now of global debt at negative interest rates. I think finally, the one thing to keep in mind is, seasonally speaking, it's a slow period for equities. If you keep in mind that August through October, that time frame is the slowest period historically speaking. Again, using Ned Davis research going back to 1952, that period is usually flat, and it's only up about 4 basis points over that time frame.
I heard recently that this is the longest economic expansion on record. Do you see it going on much longer? And what are some of the indicators that you and the investment team are watching?
Well, the economy is definitely slowing, as I mentioned earlier. And I think growth, although slow, is likely to remain positive for the next few quarters. In fact, the most recent GDP number, which was the second quarter, was up 2.1%. So we're definitely keeping a close eye on where the economy is and what the growth is like. In fact, one of the indicators we use is a reading out of the Atlanta Federal Reserve Bank. They have something out there called the GDP Now econometric model. If anyone wants to see it, you can go type in GDP Now in Google and they'll take you right to it. And right now it's predicting growth in the third quarter, the current quarter, at 2.2%, and that actually just came out today. So it's been a pretty accurate measure of growth. So I think so far that's a good indicator. The other thing we're looking at is the PMI levels, or what they call the Purchasing Manufacturing Index. That comes out monthly. Evercore ISI does a composite index of that, and right now it's at 53%. What that means is anything below 50 usually indicates that the economy is contracting. Anything above 50 means it's expanding. So it's still a pretty good number, but it has been going down recently. So it's something, again, we're keeping a pretty close look at. And I think lastly, as we always do, we look at corporate earnings, and corporate earnings right now are in the tail end of the second quarter reporting season. And right now, growth is looking to be about 3% year over year, which is much better than what was originally anticipated, which was about 2% decline. So again, I think as long as the economy is on pretty firm ground and earnings continue to grow, I think that's a pretty good backdrop. Those are things we're looking at pretty closely. And if I had added one more thing, it would just be the credit environment. And right now, as we see it, it still looks pretty good. There's a little bit of increased volatility in some of the credit spreads out there that we follow, but a great indication is mortgage delinquencies, or people that are behind their mortgage payments of 90 days or more, are at a 10 or actually almost a 12-year low. So I think the overall credit environment still looks pretty good.
So with interest rates falling and money flowing into bonds, do you still think stocks are attractive? Are valuations still attractive?
We do think stocks remain attractive. And since the recent pullbacks, valuations have actually come in line or actually fallen a little bit below their long-term averages. So right now we're trading about 16.1 times forward price earnings, and the long-term average over the last 25 years is about 16.2. So we're right in line with that. So we do think they're attractive. As we've talked about before, and I think it's important to also put into perspective, we think stocks still look pretty attractive to bonds. Right now, the S&P yields 1.9%, or the dividend yields 1.9%. About 60% of all S&P 500 companies yield more than the 10-year Treasury, which currently is about 1.6%. So over a 10-year period, we think that's a pretty attractive differential. The other thing we look at, again, relative to bonds, is the equity risk premium. And right now, the equity risk premium is about 371 basis points. That's the difference between the inversion of the S&P 500 PE ratio and the difference between the 10-year Treasury. And really, all that means is when it gets that high, above 300 basis points, equity market returns look pretty attractive, and history would tell you have a pretty good return. It's about 16% over the next 12 months. So again, that's one of the reasons we think equities still look pretty attractive. And then finally is the fund flows continue to go into bonds. I don't know when that's going to change. It's been like that for quite a while. In fact, going back to the financial crisis, some of that's probably due to demographics, and that won't change anytime soon. But I think, as far as us being at some euphoric stage in the market where people can't get enough equities, I think we're far from that so far. So I think overall, we still think the markets are attractive. We realize that there's going to be some volatility in the markets, and we're probably in that sensitive time of the year where we're going to see a little more volatility than normal. And we're also keeping a close eye on some of the things we mentioned, like credit and the economy and earnings, but so far we still have a positive bias towards equities going forward.
This brings us to the close of today's Fairport Flash. As a reminder, our goal at Fairport Wealth is inspiring families, and we strive to do this through a long-term, diversified approach. If you would like to discuss any of today's general topics in more detail, please reach out to your Fairport team. Thank you for listening, and keep an eye out for the next Fairport Flash next month.
Fairport is a group of investment professionals registered with Hightower Securities, LLC, a member of FINRA and SIPC, and with Hightower Advisors, LLC, a registered investment advisor with the SEC. Securities are offered through Hightower Securities, LLC. Advisory services are offered through Hightower Advisors, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinion, news, research, analysis, prices, or other information contained in the research is provided as a general market commentary. It does not constitute as investment advice. Fairport and Hightower shall not be in any way liable for claims that make no express or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements and errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This document was created for informational purposes only. The opinions expressed are solely those of Fairport and do not represent those of Hightower Advisors, LLC, or any of its affiliates.